Dear viewers and listeners, welcome to another episode of the Reinvent Money Show with me, Paul Buitink, and my guest today, Ronnie Stoeferle of Incrementum, co-author of the gold standard of gold reporting, In Gold We Trust. Not to be confused with the fashion brand In Gold We Trust. Hi, Ronnie. Welcome. How are you?
Hi, Paul. I'm very, very good. It's good to see you. It's been a while. And, there's a little football tournament going on, and we won last night against Ukraine. So we're going to Wembley to beat Italy next round.
Okay, that's very ambitious. I hope you guys will succeed. and maybe we can meet each other in the finals.
Yes, exactly.
Yeah. Well, thanks so much for making some time available to talk to me about your fantastic report In Gold We Trust. Do you get it often that people confuse it with the fashion brand? I didn't even know about the brand, but apparently it's quite big.
I think it's actually from the Netherlands, isn't it? Somebody told me. Yeah, not too many people confuse it, and the stuff that I saw that they produced doesn't really look good. It's super expensive, but I think there's a different audiences, different target groups. But perhaps we can come up with a cooperation between our In Gold We Trust and the In Gold We Trust brand.
So you can kind of spur some interest amongst young people for gold as an investment, possibly.
Exactly.
Yeah. Well, it's already the 15th annual report, right?
Yeah. Yes.
Yeah, and this time it's about the monetary climate change. Could you say what basically is the main takeaway of the report that people should understand?
Well, we tend to write pretty long reports, and this one is 350 pages. And what we really dive into in this report is telling people that sustainability and ESG and SRI, those are really important topics nowadays. Everybody is talking about green bonds, and everything is supposed to be sustainable, but nobody is talking about the sustainability, or rather the non-sustainability of our monetary system, which is probably even more important with all its consequences. So for us, it's been important to write about that. Why this monetary system is not sustainable. It is important to tell people that from our point of view, inflation is not a temporary or transitory phenomenon like central bankers keep telling us nowadays. From our point of view, it is a structural change that has happened. And in the report, we describe why we think that higher inflation numbers will be the new normal. So this is, I think, the main takeaway. But as you know, the report is also we dive into many different topics. Of course, mining stocks. We talk about ESG in the gold mining industry. We've got a fantastic chapter by Robert Breedlove about the question, what is money? Lynn Alden writes about long-term debt cycles. We've got more than 100 pages just discussing the current status quo of the price of gold and all important drivers. We write about the portfolio characteristics, about gold confiscations, where to safely store your gold, the combination of gold and Bitcoin. So it is, I think it's a pretty interesting read, and yeah, it's always lots of work, but I have to tell you, it's so great to get feedback really from all over the globe. People telling us, well, thank you for putting this out. It makes a big difference, and yeah, that's keeps us going.
Yeah, and it's free of charge, which is also
Yes. Yes.
amazing for the amount of work you guys put into it. Of course, you have sponsors, but still, it's a very valuable source of information, free of charge. I happily advise readers and listeners of the show to download it. And there's also a compact version, right? That's easier to read, 24
Yes.
pages, which at least gets all the basics right. And then, of course, if you have time, you can read the whole report. One of the things that you write about is the Nixon shock, of course, 50 years ago. In August will be 50 years. The moment that the gold window was closed by Nixon, and the convertibility in gold for the dollar was temporarily suspended. You call this gold's IPO. I found that clever. What do you mean exactly with that?
No, well, basically, now we're soon having the 15th anniversary, and I don't know. Over here, we're speaking of the golden wedding or the golden anniversary. So I think that's pretty funny. Uh, this was basically the first time when we saw that money wasn't backed by gold anymore. When basically all currencies over the globe were floating, and the dollar became the center. The not gold-backed dollar, the fiat dollar, became the center of our monetary universe. And of course, it has had enormous consequences. And I think the 1970s were already some sort of a litmus test for the new unbacked reserve currency. And many people forget that I think in the end of the 1970s, the US government had to issue government bonds denominated in Swiss francs and in Deutschmark, because people didn't trust the US dollar anymore. They didn't like the US dollar. They thought that, well, inflation will continue, and it might even move into a hyperinflation. And then, of course, Paul Volcker came in. So I think it's really important to step back a bit, to talk about the history of our monetary system. In German, we say Geldgeschichte ist Weltgeschichte, and therefore I think it's important to tell people that we're not in a cyclical crisis, but rather in a systemic crisis. And for some reason, nobody knows anything about our monetary system. Nobody knows what money is, how money is created, and we try to make an effort to educate and inform people about those really fundamental things. And at the end, of course, we're an investment company and we're asset managers. So we think the changes that have happened over the last year, for example, the fact that big government is back, that nobody really cares about budget deficits anymore, the fact that we are moving from monetary dominance to fiscal dominance, the fact that central bank digital currencies are getting more and more important, the fact that we're seeing completely new tasks for monetary policy. I mean, if you listen to the ECB or the Federal Reserve, it sometimes seems that there's like a Greenpeace activist or social workers, and this is not, I don't want to judge that, I'm just observing it. It seems that there are new mandates. I mean, I think there wasn't any election or real decision about that, but this is happening. And so the fact that the self-designation of central bankers as monetary guardians, in German we say Währungshüter, which is a great word. I think this self-designation of monetary guardians is really out of date nowadays. So this, in the combination with this merging of monetary and fiscal stimulus or fiscal policy, some sort like MMT light that we're seeing now, I think this is really crucial to understand. And for some reason, most investors don't really care about those topics. For us, that's just our humble opinion. They're really crucial to understand and to anticipate future movements in markets.
Yeah, interesting point you made there about the US having to borrow in foreign currency late 70s. I didn't know about that, but that's quite telling that they had to resort to those measures, and it says a lot about trust in the dollar at that moment. You also, you state that we currently have an unbacked currency since 1701. At the same time, we do see central banks having gold on their balance sheet. Couldn't you argue that we have still indirectly backed fiat currencies with gold, because especially lately, of course, central banks of developing nations are accumulating gold, and we know from statements from the Bundesbank and also from the Dutch central bank that they really value their gold position, and they don't seem to be eager to sell it. So couldn't you state that we still have partially gold-backed currencies?
Well, you know, the gold backing, even at current prices, I think for the US, it's roughly 6 or 7%. That means, you know, prices are probably way too low. And I think that, I don't know, I think Ron Paul once questioned or grilled Bernanke. And I think that Bernanke said that it's just a tradition that they're holding gold. I think that's actually not true. I think that's a lie. I think that most central bankers really know why they're holding gold as one of their central reserves of their balance sheets. And I mean, it's no coincidence. You know, the US has 8,100 tons. Of course, there's many theories that it's not there. I assume that it is there. The Eurozone holds more than 12,000 tons, and countries not in the Eurozone but in the European Union, like Hungary, like Poland, are buying significant amounts of gold. China is buying every ounce they can get. China is now the biggest gold producer, and no ounce leaves the country. We're seeing that the Russians have bought huge amounts of gold over the last couple of years. The IMF holds more than 3,000 tons. So I think really the most important players, they already own quite a lot of gold. And our case has always been in the transition phase from one currency system to another currency system. I think this is will be the point when people won't care, you know, is the price of gold at 70.50 or 17.90. I think we will talk about completely different numbers then. In the Eurozone, central banks hold huge amounts of gold. So this was kind of the trust anchor for the new currency. And I think, you know, at some point, you know, that shouldn't be gloom and doom forecast. But, you know, if you study monetary history, it just happens every couple of decades. And I think in this transition phase, I think gold will play a major role to establish trust in a new currency, in a new world-leading currency.
Yeah, earlier you touched upon the price in a video on your website, end of May. You said that gold would make a new attempt for a record high this year. Past few days, though, gold has been going down a lot because of possible rate hikes by the Fed. Does this change your outlook? You think the Fed is really going to raise rates?
Well, Paul, you know, the last week was brutal. It was really tough. We didn't expect such a big change in market expectations and such a big rotation from my point of view. You know, the nominal Fed fund rate projections, they rose to 0.8% from 0.5% in March, so 29 basis points, and this is for the end of 2023, so still 2.5 years from now. I think nobody really knows what the Fed will do between now and 2023, including the Fed itself. I think it's clear that the Federal Reserve policy will remain very, very loose. And even by its own projections, the Fed will be behind the curve through 2023. So from my point of view, it is something that doesn't scare me at all. I think what really the market dislikes is the fact that Powell seems to have lost control of the board. So I think that there's quite a lot of different opinions, and the market just hate uncertainty. We're seeing a tremendous flattening of the curve, almost as if the next recession would also already be on the horizon. And the big question for me is, now that they said, well, we are now becoming more hawkish again, yeah, so everything is fine, and inflation, we've got it under control. And now they really started on this more hawkish path. And of course, it's all a confidence game. Now, the big question is, how will the Federal Reserve respond to downside surprises in economic data? How will they respond to further weakness in the labor market? How will they respond if inflation expectations should come down dramatically? How will they respond to a sell-off in commodities, and especially in equities and more volatility? Will they become more dovish right again? Um, I'm not sure. Then they would finally complete. The market would lose confidence in them. So it is kind of a lose-lose situation. However, I think that for gold, I would be a liar if I would be telling you, well, we will go to all-time highs very, very quickly. I think quite a lot of damage has been done to the chart, definitely. We're seeing that in the commodities markets, I mean, it was heavily overbought. We wrote that in the report. It's coming down, and I think that inflation expectations are coming down. And therefore, I think, we're taking a breather, which is normal. I don't really see a big change for our forecasts. It's just gonna happen a bit later. And in the report, as you've said, we show one model that is based on the options market, telling us that chances for a new year high, which would be a new all-time high, are significantly higher than the probability for a new 52-week low. And I stick to that, and I think we're in a fantastic bull market. People shouldn't become too greedy. Gold was up 25% last year. Now we're down 6% in dollar terms. Gold was up, I think, 15% in euro terms last year. It was up 22% in euro terms in 2019. So I think gold's job is not to make you rich. I think we really have to manage expectations. People shouldn't expect Bitcoin-like performances when it comes to gold. But of course, I mean, the volatility is different, and therefore, I think gold is doing well. It is acting like a solid defender or a really good goalkeeper. What was the name of this great Dutch goalkeeper? Edwin van der Sar.
Yeah.
And I think what was the defender? Jaap Stam. So I always come up with sports analogies. So perhaps gold is the Jaap Stam or the Edwin van der Sar in your portfolio, but its job is not to score the goals. And I think this is what many people miss.
Yeah, well, talking about Bitcoin and greed and losses and brutality, of course, and then using perhaps one of a German word, Schadenfreude. I mean, a gold investor has been suffering a bit over the past few days, but the crypto investor and Bitcoin investor have been suffering even more. In your report, you also mentioned that gold's weakness can partially be explained by some outflow from investment money flowing into Bitcoin and other cryptos and away from gold. With the current slaughter in the crypto market, do you expect some of the money to flow back to gold?
Perhaps. Yes. Paul, I think it's first of all, I think it's what we're seeing, this whole Schadenfreude that we're seeing from the gold camp now that Bitcoin is down. I think that's it bugs me, and I think it's something that doesn't make any sense, because both currencies basically have pretty similar functions, and I think most importantly this high stock to flow ratio and the very low future inflation. I mean, this is really something that differentiates gold and Bitcoin from everything else, and therefore, we are pretty agnostic. For us, Bitcoin is not a religion, gold is not a religion. Both are hard assets, or let's say currencies that cannot be inflated. And I think in a highly inflationary world, this is something that that will continue to be very, very important, and that will be sought after. However, when it comes to Bitcoin at the moment, well, this is brutal, and I think it's a really tough sell-off. From my point of view, I mean, we've got two funds that combine physical gold, mining companies, silver with Bitcoin and with some other cryptocurrencies. So we like gold for stability and we have Bitcoin for convexity. We use the options market because volatility can be seen as an enemy, but also as your friend. And via options, you're getting enormous premiums at the moment with this high volatility in Bitcoin. So we are actually making use of that, and you know. I think that, you know, taking a step back and perhaps from a bit more philosophic point of view, I think right at the beginning of the whole Bitcoin movement, and we followed that pretty early on. I think that most people in the community, you know, they really wanted to change our monetary system. They had they knew about the flaws of our monetary system. They knew that Satoshi Nakamoto basically created Bitcoin as an answer and a solution to the flaws of our monetary system. I think he knew the Austrian school quite well. He knew about gold really well. And I think at the beginning, this was really the dominant narrative, like people trying to, you know, fight against the fiat money system. Then, of course, the second narrative once Bitcoin came up was, well, this is only for illegal activities. Yeah, it was a bit like 2016, 2017, and then there's lots of studies basically saying, well, you know, perhaps it's 1 or 2% used for illegal activities, but that's basically with every currency. And then the new narrative is Bitcoin is is energy intensive, and it's from an ESG point of view, it's just the worst. And I think that was also the main reason. I think that Elon Musk got tremendous pressure from ESG funds. They said, well, you either stop tweeting about this Bitcoin thing, or we will kick you out of our ESG funds. I think this one was really one of the main triggers for his U-turn. But this is the new narrative, and I think that that the whole ecosystem is working on that, and that there's good solutions for that out there. And I mean, let's face it, at 64,000, I think it was extremely overbought. We saw all the signs of a bubble. Now we're trading at roughly 30,000. Normally, I mean, the greatest buying opportunities were at drawdowns of 80%. So we would have to go to, I think, 12,000. Still quite a lot of room left, but I cannot rule it out. But I think, you know, that Bitcoin also did a really good job informing many people about our monetary system, leaving our monetary system, and of course, it had to be expected that this is not something that central bankers and politicians really like. But you know, for us, I think many people say Bitcoin is completely unregulated. I think that's nonsense. I mean, over here, for us in 2016, they gave us a hard time launching a fund that invests in Bitcoin. But now we've got this regulatory framework, and we are seeing that there's so many big players coming into the market. So I think it's just too late to stop this wave, yeah, because there's so much happening, and I think there's so much innovation happening. I'm meeting so many brilliant minds. I'm meeting so many really ambitious entrepreneurs that only see solutions and potential, and not threats and risks, like people are seeing mostly in the banking industry and the traditional finance industry. So I actually really like this, the feeling and this whole mood in the industry. Of course, most projects will fail, but there will be a few, and I think Bitcoin will be one of them that will completely change the way we work, the way we save and spend money, and I think it cannot be stopped. That's already too late.
Yeah, no, I fully agree with you, and I like the fact that you also embrace both. And like, for example, I'm going to work as a managing director of the Nixon precious metals group from the 1st of August here in the Netherlands. But I also, of course, have crypto background. I'm personally invested in crypto, and I like the industry a lot, and I like cooperating together, and I don't like this rivalry too much between gold on the one hand and Bitcoin on the other hand, or between Bitcoin and a lot of other interesting projects. Of course, there's also a lot of bad blood sometimes, which I think is a pity. Do you also then consider to add other cryptocurrencies to your fund, the mixed fund that you now have between precious metals and Bitcoin? Do you, for example, consider Ether or some other projects?
Yes, we do, and we've got some investments in the DeFi space, for example. I think one of the most one of the problems that we're seeing at the moment is a lack of liquidity. And of course, you know, the structures that are sometimes offered are really hard to invest in for a usage fund, for example. Our other fund is a so-called AIF fund. So we can take Bitcoin in cold storage, for example. We can write options on the CME. And I think that people forget that the whole infrastructure and the whole ecosystem really professionalized. Now we've got a futures market, we've got an options market, we've got custody solutions. I think really that the space has grown up. And I completely agree with you, Paul. I think this rivalry is just ridiculous. And I once said in an interview, it's like, you know, you can go from A to B in a Volvo SUV, and you will arrive there very safely, and it's gonna be comfortable. Or you can ride a Ducati motorcycle. Of course, you can get from A to B. You will be much faster. It will be much more fun, but it's also more risky. And you know, as soon as it starts raining or snowing, you probably will rather be in the Volvo SUV and not on the Ducati motorcycle. But why can't you like both? Yeah. So I think this rivalry, this is coming from both sides, from the gold camp and from the crypto camp. I think this is it's nonsense, and it doesn't really help, you know, establishing or making the case for gold or cryptos.
Well, let's focus again on the common adversary, enemy, the central banks. I mean, of course, also there, I want to be nuanced, because there's also a lot of good central bankers that really try to do their best in order to help society. But let's we both live, of course, in the Eurozone. We already briefly discussed the Fed. The ECB is working on a strategic review, right? Do you know the latest details about that review? When is it going to be presented? To what extent have countries any influence on what is going to be the outcome of the review?
Well, Mrs. Lagarde, she hasn't called me yet. My partner Mark, he keeps asking questions to Lagarde and the ECB on Twitter. I actually don't know when the strategic review will end and what it will bring. Probably not too much positive stuff. But I think that some sort of yield curve control, implicit or explicit, might be announced. I think that if you follow the synchronization of central bank policy, I think it's not a bold call to say that the ECB will also introduce some sort of average inflation targeting at some point. And I think that's really a big shift that market participants didn't really recognize. It was announced last year. by Jay Powell, and actually, you know, it says that as inflation rates were undershooting over the last couple of years, we will now allow inflation rates to overshoot. And the interesting thing is, I mean, we researched that for the report because we said, okay, well, how much leeway, how much room do we have for inflation surprises on the upside? And actually, they don't tell, you know, how they calculate it. So what time frame do they use? And it's a big difference if you say, well, we're looking back 10 years or 20 years, and if we look into the future 1, 2, 3 years. So nobody really knows how they will handle this average inflation target. But it has been a big shift because now 2% isn't the ceiling. It means that, well, you know, even though we're significantly above 2%, the Federal Reserve doesn't have to raise interest rates. I think something similar will be introduced by the ECB. And I think that, you know, if you listen to Mrs. Lagarde, yeah, it's tough because she's not following the mandate of the ECB, and this is something that that we criticize because it is not the mandate of the ECB to change climate change and to be a social worker, something like that. I mean, that's nice that she wants to change the world for the positive, but it is not her mandate. Yeah, I
At
mean,
least in Germany, there's the Constitutional Court in Karlsruhe that every now and then tries to question some of these policy decisions. So it looks like there's not enough space for more cases in Karlsruhe, or you think because
yeah,
they're
but
going to work on the latest program from the ECB as well, right?
yes, but you know, Karlsruhe has, I think their rulings have been highly interesting, but they were always way too late. So once they said, well, this isn't okay from our point of view, it was already too late, you know, because those programs were already introduced 2 or 3 years before. So I mean, from a political point of view, that's a highly questionable strategy that is being followed. But of course, you know, never waste a crisis, and I think we saw that last year when basically this credo of the frugal Swabian housewife, you know, with balanced budgets and, you know, even budget surpluses. I mean, this is over for now. I mean, forget it over the next couple of years. And I think that it's really important to see, or to say that now I think it's really fiscal policy that is ruling. I think we should focus much more on what the White House is telling us than what Mr. Powell is telling us. And why is it important? We saw with quantitative easing, of course, there's this transmission mechanism. So over the banking system, we should create inflation and economic growth. Well, it didn't really work so well so far. It created enormous asset price inflation. But now with fiscal stimulus, you know, this is like a sugar rush. Like if you drink like 2 Red Bull, you know, it kicks in pretty quickly, but then it fades off, and it's probably not very healthy. So I think that if we are right that we will see much more fiscal stimulus, it has a much more direct and a faster impact on the economy and on inflation. But we also know that there's this declining marginal utility, so that we need more and more to see any effect. And I think this is really something that that people should focus more on. I think that big government is back. I think that politicians last year saw, well, you know, we can introduce quite a lot, and we can, you know, through this crisis, well, nobody really cared about the numbers, and just in Austria it was 54 billion, and you know, who really can make a difference between if it's like 30 billion or 54 billion. I mean, those numbers, they're just staggering. And $1 trillion used to be a big number, but now with those packages coming out of the White House, I think everybody is kind of losing sight, and we don't see, how shall I put it? I think we just don't understand those numbers anymore. It reminds me a bit of the Weimar hyperinflation. And if you read the books, be it The World of Yesterday by Stefan Zweig or When Money Dies, I think it is
I have him
something
here.
that
This is the 50 million mark, only printed on one side to save ink. And of course, here we have the $100 trillion from Zimbabwe, of course.
Yeah.
One has to have that one, of course, also in the collection. But yeah, people are getting used to these numbers, and so they slowly but surely can increase them without people protesting too much about it. But do you think then fiscal dominance, of course, is now in full swing? In the US, it's easier to implement because in the Eurozone, of course, you have all these countries bickering and arguing. We have the recovery fund now, but of course that was very difficult for Brussels to put it in place. Are you therefore more bearish on the US dollar than the euro in terms of high inflation and devaluation?
Well, I would say for the really short term, we were wrong, and we thought when the Dixie, the dollar index, was at between 89 and 90, we thought that this is it and that we would see a big move down. Now it has recovered last week because of the kind of U-turn of monetary policy that we talked about, and because positioning in the US dollar was extremely bearish, so everybody was already in the bearish camp. But I think over the medium to long term, we expect a weaker US dollar, and this is actually what the US wants and needs, what the whole world actually wants and needs. But the problem is nobody really wants to have a strong currency, and for me, a strong currency is like a fitness program for the economy. And as far as I know, not those countries with the weakest currencies are the most prosperous and wealthy countries. It is rather countries with traditionally strong currencies, because as I said, it is like a fitness program. You have to be more flexible. You have to be more innovative. You have to have better products. So I clearly see some sort of, I don't want to say currency wars, but we are seeing that currencies, fiat currencies, are just permanently devaluing against hard assets, and especially against gold. Perhaps this trend could accelerate going forward. And from my point of view, it is really important to say it is not the price of gold that is rising or falling. It is the purchasing power of the US dollar, of the euro, that is rising or falling. So you need more units of euros to buy 1 unit of gold, but you also need more units of euros to buy 1 house. I mean, real estate prices are going crazy. It is the same. A friend of mine, he enjoys drinking whiskey, and he's also collecting whiskey. He says, prices are going crazy, and you're seeing it in all sorts of different areas. So it is a bit of like the beginning of this crack-up boom that Ludwig von Mises described in Human Action. I think we are beginning to see this. But also, if you study the hyperinflation in Weimar, for example, of course, big moves on the upside, but then small but really brutal deflationary moves. Yeah. And I know from studying it that there were quite a lot of investors that were shaken out during those deflationary moves. Yeah. So that's fairly interesting, and that tells you, well, don't take too much leverage, and yeah, just stick to the plan.
Okay, so buckle up. We're in for a wild ride. Okay, well, thanks a lot, Ronnie. I know you're a bit pressured with time, so let's wrap it up. Anything from your end that you want to add? Any final remarks?
No, thank you for the invitation. It was good to see you. I think it's really been a while. I wish the Dutch national team all the best. And you know, if you've got some time to read and to learn more about gold, I invite you to download our In Gold We Trust report. I think it's worth the time. It's worth the investment. It's free of charge, but you can. It will take probably a day to work through, but I think it's a great addition, and Mark and I and the whole team are pretty proud and very happy about this very positive feedback from all over the globe.
Yeah, you should be. And I'm going to bring the report with me on holidays to read it completely. I will put it in the show notes, of course, where you can download it. It's in goldwetrust.report, and I advise all the listeners to study it well. Yeah, it would be nice to see each other again in person. Like the last time was 9 years ago, I believe, something like that. So perhaps anytime soon. Thanks, Ronnie.
Absolutely. Looking forward. Thank you very much, Paul. It was a pleasure. Thanks.
Bye.
Bye.